It's a pleasure to moderate this panel of extremely experienced and engaged impact investors. We want to take advantage of this broad experience we have here. These people know a lot, not only about identifying good investment opportunities, but also about engaging with local entrepreneurs, managing and measuring impact, mitigating risks, and partnering with institutional investors. All this knowledge is crucial when it comes to scaling sustainable investing in emerging markets. Today, we want to discuss what it takes to mobilize more institutional investors for investments in emerging markets and for the use of achieving SDGs overall, and more specifically into investment opportunities that contribute solving the climate crisis. We all have heard the estimates of capital that is needed to combat the climate crisis, incredibly large numbers. We also heard estimates about the need of capital for the SDGs, which is a broader set of sustainable goals, including climate. Without institutional investors and without investments in emerging markets, these goals cannot be met. So how can we convince more institutional investors to invest in impact and in emerging markets? In emerging markets, many of the global challenges, but also opportunities come together. It's also the place where many basic needs still can't be met, like access to healthcare or education for all. And many regions of what is counted as emerging markets are the most vulnerable to climate change. But it's also where there is economic growth, an increasing number of people reaching middle class, and where there are, as a consequence, interesting investment opportunities. With this in mind, I would like to turn to the panelists and talk about these opportunities. I'd like to start with Liz. So CDC has invested over $1 billion in climate-related investments. Could you give us a quick overview of what you did and also what impact goals you want to achieve with these investments?
Well, thank you very much. Yes, we have indeed committed over $1 billion in climate finance in Africa and South Asia, that being the regions we invest in. And our strategy aligns with the Paris Agreement and commits us to achieving net zero by 2050. We have three particular elements to our strategy. The net zero emissions at a portfolio level, as well as how investments contribute to the country's net zero pathway. And if we come on to talk about investments in particular, I can talk more about how important it is to have a clear understanding of the country's own plans and how that and the regulatory framework can be very supportive. Secondly, the support for the transition of workers and communities from high to low carbon intensive sectors by investing in job creation, skills development across the portfolio, and looking for those investments to support that. And thirdly, an increased focus on adaptation and measures to strengthen the resilience of communities. Because as you say, some of the communities that we invest in are the most vulnerable to climate change. And we have invested across such a wide range of both sectors and using different products. For example, from providing 13 million people across Africa with access to solar panels, forestry, tree planting, again in Africa, Sierra Leone and Ghana, creating jobs and contributing to sequestration. And also very large scale investments with others. For example, the Benban solar park in Egypt, which I believe, although I haven't been there myself, is even visible from space in terms of, the sort of huge ambition and now execution of such large projects. So quite a wide range of sectors and products.
Thanks, Liz. I'd like to turn to Sandeep. Elevar focuses a lot on, or primarily on the low-income population and works closely with local entrepreneurs. Could you tell us a bit more about where is the need from that perspective and how can you capture those as an investor?
No, thank you, and thank you for this opportunity. In some respects, when I was put onto this panel, it was a bit of an odd situation given that sustainability and climate change has not been the core of our strategy. The emphasis on affordability and essential services for low-income communities has been the entrepreneurial journey that we've been on since the early 2000s to mid-2000s. But I think as I thought about it and reflected, I really felt that this dichotomy of two aspects of impact that we're all looking at, one is the climate change and sustainability dimension. And I think secondly, this whole issue on affordability in many respects is a false dichotomy. If we're really going to be able to address the challenges of both low-income communities and the climate, we're going to have to think about solutions that emerge from the emerging markets and work for the emerging markets, just given the population scale that exists within the emerging markets. And in that respect, for us, given that, again, just to emphasize, we focus on essential services, and by that we mean financial inclusion. We mean market linkages for micro and small enterprises. We mean emphasis on supply chains within the agricultural context, and education and employability being the last theme. I just think we need an extremely disciplined focus, a method, if you will, to build companies that focus on the needs and aspirations of low-income communities. And when you think about the needs and aspirations of low-income communities, we have a real opportunity within the emerging markets to leapfrog in many respects from dated methodologies into methodologies that work for these communities and also address broader challenges. We've currently, invested through 4 funds. We've invested just short of $200 million into 40 odd companies, and almost invariably been, the capital that got the business models proven out and scaled. But I think if we just were to think in a broader context, many experiments have started which have been successful and maybe some not so successful in terms of thinking about these solutions very, very specifically within the emerging markets context. For example, we have a company that focuses on the two-wheeler industry. And they're thinking, anticipating the changes of the two-wheeler industry in the context of electric vehicles, is that the emerging markets will have completely different business models. If you were to think about range anxiety, you would think about charging of batteries, et cetera, than let's say the Western world. If you take, this is a company called Wheels EMI. If you take another company within our portfolio, which is called Samanati, which is in the agricultural finance and trade credit and trading context, just the nature of solutions that they are going to have to think about and work with their customers is just going to be very, very specific given ground realities. So I think those are the factors that we need to think about, both in terms of allocation of capital from the limited partners, from institutional capital, and then fund managers to portfolio companies on an overall basis. I'll pause here, and I think at a later point can pick up some questions. Thank you again.
Thanks, that was very interesting. Arturo, I'd like to turn to you. With Bridge Impact, you chose an indirect investment approach, so a fund of funds approach. Why is this, and why do you think, what do you think are important topics in climate investing in emerging markets in particular?
Thank you, Mishan. So addressing the first question, why did we choose an indirect approach? Basically, the subject of today's call is how do we scale sustainable investments into emerging markets, where we think that in order to scale, we need to involve institutional investors like pension funds. What we see at Impact Bridge when we speak with these institutional investors, and I'm sure that the audience would agree, is that they have the intention of increasing their exposure to impact investing, but they have significant challenges and they see significant risks, both from the financial side and from the impact point of view. We think that a fund of funds is a very good way to decrease and mitigate these risks. Through a fund of funds, we can invest with the best partners in each region, with the experts in each strategy, and build a diversified global multi-strategy fund that is robust to market stress and specific. And we believe that that is a very good way to approach it, maintaining high impact standards and also in the financial side, high professional rigor that we demand from all the funds we invest in. Regarding climate change, from the impact point of view, and especially in emerging markets, we believe that not all investments in climate change are equally impactful. And being the huge threat that climate change is today, we need to be, as investors, we need to be very strategic. How do we allocate capital from the impact point of view? We need to think very well, what are the solutions that we need that are not in the market yet, or what are the infrastructure that we need, and see how funded or how underfunded these solutions generally are, and which are the ones that are least funded. For example, we believe that in emerging markets, climate adaptation is something that is totally essential and that is clearly underfunded. In climate change, we have climate change mitigation, preventing climate change from happening, and climate change adaptation, adapting today to the effects that climate change is having. And 94% of global investment in climate change goes to climate change mitigation, and only 6% to climate change adaptation. When we are today seeing the effect that climate change is having, and especially in the most vulnerable, like smallholder farmers. So we definitely believe that we need to think strategically of how to allocate resources to climate change, and especially invest in climate change adaptation, because even if we're optimists and we believe we're going to remain within the Paris Agreement, the situation is going to get much worse over the next few years. So, and clearly the most vulnerable are the ones that are most affected. So we need to invest in water, and we need to invest in the resilience of the smallholder farmers.
Yeah, absolutely right. And I suppose, Gary, you wouldn't agree more with this. So turning to you, actually, so with Silver Street Capital, you've been managing actually 2 funds now in Africa for a few years, and you have been able to mobilize a good number of institutional investors. So please tell us a bit more about your strategy and why you chose it.
Yes, happy to do it. Welcome, everyone. Silver Street Capital is set up first in 2007. We've been going for 14 years. We are impact investors and have been throughout that time. We have 2 funds, as Miriam said, and manage around about $500 million under management. Our funds are both classified as Article 9 under SFDR, and our sustainable goal is to seek attractive returns for investors whilst achieving a substantial positive social, environmental, and climate impact. We measure and monitor and report back to our investors in detail on achieving those goals. And our approach to climate, in particular sustainability, is by we're looking at global emissions, and close to 3/4 of emissions are actually directly and indirectly from energy of some sorts, energy generation or energy use across all sectors. Apart from that, outside of energy, agriculture is the biggest contributor to greenhouse gases globally, represents about 2/3 of the emissions outside of the energy category. And that's the area we're addressing. And it covers things like deforestation, cropland, crop burning, soils maintenance, erosion, things like that. And that's the area that we focus on. And how do we do that? In Africa, our folks, we only invest in Africa, sub-Saharan Africa. We see the smallholder farmer as our impact target. In sub-Saharan Africa, perhaps 60% of the population live on these farms. They're typically 1 to 2 hectares, typically managed by a woman. So the husband is often in town on a factory or in a mine, somewhere like that. And this is generally the lowest income group in these economies. And they're low income because they're growing low value crops, often subsistence crops such as cassava and maize. They're achieving very low yields. So typically 1.5 to 2 tons per hectare for maize, for example, whereas the global average is 6 tons. And the farming practices are unsustainable, using often a slash and burn type approach, monocropping, on this piece of land, and that requires the farmer to keep moving every 5 or 6 years and cut more woods down. So that's our impact target, and our investments are surrounding and focused on those farmers and supporting them on the inputs, on-farm training to get the techniques more sustainable, and providing them markets for higher value crops they can use in rotation. And happy to talk a little bit more about that later. Thanks.
Thanks, Phil. I would like to turn to the scaling topic. And as we, or let's say everyone that has been involved in investing in impact in emerging markets has got aware of the fact that it's still difficult to scale. And as we also know, institutional investors have a strong need for quite a sizable amount of an investment vehicle. So I'd like to talk a little bit about this issue, about how to find investable or investable topics that have enough size, enough transactions to create an investable product for institutional investors. And I think it's also linked to to a higher level question about how to still create and enforce the ecosystem. For this, maybe Sandeep, if you are managing the largest, well, besides CDC obviously, but let's say you're managing a large amount of capital. How do you manage to find and identify these transactions that in the end can be pooled for an institutional investment pool?
Very interesting question, and I wish I had the answer readily available. But let me attempt a hypothesis out here, because I think this cuts to the crux if we really want to change the world. We've deployed just short of $200 million of our own equity through the 4 funds that we've raised into 40 odd companies. So that sets the context of our equity. The total amount of co-investor capital that's come into our portfolio is something like $1.4 billion. So if you will, the equity leverage that is available in our portfolio is at the minimum 7 times. I would argue that by the time some of those companies which are more recent scale up more, we'll probably get up much more significantly. Interestingly, 75% of that capital approximately is commercial capital, don't have an impact lens at all. 25% of that equity leverage is coming from impact sources. And yet we are significantly undercapitalized. And that's just the reality of it. So if you were to think about it in terms of the deployment of capital, the opportunity exists. If you get the right entrepreneurs, the themes that we are investing in, given that they're essential in nature, even in a COVID situation, you would have significant growth opportunities because you're dealing with essential services. And so the challenge in many respects is to create new business models, create new entrepreneurial opportunities to be able to absorb that capital, which is one side of the equation. And the other side of the equation is to raise the amount of capital. Now, if we're going to create, by very definition, because of fund structures, you have to be smaller. Because you have to be more creative and really get those opportunities going. And on the supply side of capital, then you need large pools of capital as those companies scale, because you want to maintain your influence. And you can also create a pipe, if you will, for large institutional investors to invest. So that's the crux of the challenge. I think we need to get creative with LPs ultimately, and with institutional capital. We need to find co-investment pools. Through our 4 funds, we've had significant co-investment rights in terms of documentation, but not much of capital has actually come through that mechanism. I think we need to think about separate pools of capital. You think about managed pools of capital. We think about pledge pools of capital, etc., so that investors who want to deploy capital, when the opportunities actually emerge from within our portfolio and somebody is really scaling up to the point where they can absorb a lot of capital, create a lot of impact on the ground, both from an affordability as well as from a sustainability standpoint, then we have the opportunity to be able to bring that capital and take it to the entrepreneurial opportunities that we've already invested in. So I think that's ultimately is, for me, an issue of financial engineering. The capital is there, but we have a broken fund model construct, because where the creativity, it forces you to be small. And then if you get large, then you have very little creativity ultimately to be able to make changes to business models to get them to focus on the issues that we want to focus on.
Yeah, great point. Gary, you're also managing the relatively large pools, and this even, I say even in Africa, which is obviously not the easiest region. How are you going about it?
Well, the key is to have a structure and approach to sourcing and implementing impact investments. And I was describing earlier our philosophy and our impact target. As long as you're clear on that. And so if we look at the smallholder farmer and what do they need? So part of the issue they have is they're using farm safe seed, so the wrong seed. We've invested into a seed business which has germplasm seed, hybrid seed. It's not GMO, but it's improved seed that basically doubles the farmer's yields at least. And so by investing in that company and then helping it expand, one has a direct impact on farmers and on sustainability. And then secondly, in each of the investments you want to combine in, there's always going to be extension work because you're working with thousands of smallholder farmers, training. One of our projects in Tanzania has 100,000 poultry farmers involved. We have 35 extension officers, we have a training center, we have agents, 220 agent distribution centers. You have to create and build that. And to get the sustainability right on the farms. And then finally, on the market side, if you can provide a market for a smallholder farmer in a high value crop, they can introduce it into the crop rotation, which brings them more sustainable practices. And of course, it's always combining with training. So we're narrowing down our search to those parts of the value chain. A market often looks like a processing plant. We're going to process tomatoes into tomato paste, which we'll sell to Heinz and Unilever. On the input side, seed, fertilizer, or other inputs, and then always with the training. Once we've done that, we're using our own networks to source the deals. We don't really use common ones because we're looking for specific opportunities in specific locations. And then to scale it up, our philosophy, whether it's right or wrong, is to try and build platforms. So here's a seed business. We bought a company called Zamseed. It's in Zambia. Can we build a regional platform with that business? It has all the ingredients there, the right germplasm aimed at smallholder farmers, drought tolerant, disease tolerant. Build a platform, add capital, and create a regional business. Similarly, a poultry business. And so that allows one to develop proper sized businesses that they're not capable of exiting at some point in the future. And then choosing the countries, we score countries. We have a quantitative approach. We on 7 factors, independent factors. We do that every year. We're monitoring trends. We have an intuitive feel. And then finally, the key to any of this, to execution, is to have the top team essentially on the ground executing the strategy for you. If you're in the impact world, by definition, you're building something, you're developing something that isn't there. That's why you're creating the multiplier effect. You're fixing something in a value chain to helping those farmers. And to do that, it's difficult in Africa. So you need to have the absolutely top team who can execute on the ground. They need to be very good in their expertise, area of expertise, but highly ethical and aligned with your views on impact.
Mm. Yeah, I think these 2 points mentioned are super relevant. One is about having a team on the ground, certainly. The other part, which I like a lot, is about the creativity that Sandeep mentioned. Like Arturo, you're, as a fund manager, you're obviously screening globally, I think even the market for such investment opportunities, I suppose. How do you see the market, and what do you think is there and what is not there yet?
Yes, so our experience, we've switched the lens from a direct investment, as we've heard as we have just heard, to a fund investment. We look for funds. How do we source funds that are ready to accept institutional capital, right? That's the question, and that are proficient both in the financial side and also on the impact side. Platforms such as Phenix, of course, are great tools to get access to reputable managers. Another perhaps idea for our listeners that is not so evident is to see what the DFIs are doing, and we have lists today from CDC, but the truth is that DFIs have led the way in many aspects in impact investing. They've been investing decades doing this type of investments. Before it was called impact investing, and they're also doing a lot of things to promote, and within their mission is to promote and channel and act as catalysts of private capital. So I think it's a great source of knowledge. They're doing many things to help us, private investors, to allocate more and more capital. Blended finance is just one thing where DFIs assume more risk in a first loss tranche. So clearly make the opportunities more interesting, decreasing the risk. And there are many opportunities in blended finance that just from a pure financial point of view, the structure nowadays is extremely interesting, even if you don't think about impact. So I think that's a way a place to look. Technical assistance is key, as the other panelists have mentioned. We really need to build the knowledge and the technical assistance, which are basically grant capital that DFIs provide to the investments where they invest, also help de-risk these investments, sometimes supporting the CFOs in the financial reporting or in the impact reporting or in their operational activities. But DFIs are also promoting a lot of knowledge in the industry, publishing reports. For CDC, the ESG toolkit that they have for fund managers is a great place to start of how fund managers should approach the ESG analysis and management of a fund. So I think that is one point. And clearly, how do we see the market? Fortunately, we see the market growing. Sometimes it's not as easy, and as they mentioned, we see perhaps a missing middle as well in terms of funds. We see a lot of large funds and a lot of small funds, but it's difficult to allocate capital to the smallest funds. But we see fund managers gaining more experience, more track record, and being able to raise more assets. So little by little, the universe is getting larger and more professional, which is obviously something good for all.
Yeah, I think that's let's say good bridge over to Liz actually. I think Arturo has just mentioned CDC is one of the forces that helps to create this ecosystem. CDC invests a lot in VC and uses catalytic capital. Liz, how do you think CDC concretely, could you give us some examples like how CDC contributes to building this ecosystem, and where have you seen maybe institutional investors coming in?
Well, I think we can indeed take risk or come in at different stages in all sorts of different ways. I mean, when we're thinking about scale in terms of our markets, India is a market of scale. And it does change and develop quite rapidly. So, I mean, even back in 2018, we founded a utility scale renewable solar and wind generation platform. And at that stage, I think, it was seen as kind of quite early stage, and we took the risk. And we had ambition to build that up. And to date, IANA has received equity funding of over $700 million with others, for example, the National Investment and Infrastructure Fund, the Green Growth Equity Fund coming in, supporting that growth. And I think that is one example where DFIs can be there right at the start, taking that early stage risk with our ESG, as Arturo mentioned, standards, and also being very thoughtful about. I mean, we in that area were very thoughtful about where we preferred, as it were, investments to be made in terms of sort of regionally, and also in terms of really trying to simulate the kind of greenfield market, because that's where we felt we would have more impact. there's a place for, there's a place for others in the ecosystem, but that's where we felt we were best placed. And I think that that's now over 1 gigawatt of generation capacity under various stages of development and operation. So I mean, that really shows there are opportunities at scale. And it has, as I also mentioned, it has, changed. So even over the last sort of 12 to 18 months, and that also is in the kind of context of the Indian government's ambitions is also very helpful, providing that kind of certainty. I mean, if you turn to sort of Africa, obviously it's a much more kind of fragmented market, and despite the fact I mentioned sort of Egypt, you probably won't find kind of opportunities of that kind of scale. But I think we can take risk at other kind of in other vehicles, as you mentioned, venture capital funds. We've started doing more venture capital investing right at the early stage. For example, providing technology or kind of in funds, providing investments behind technology solutions for farmers. Putting really the information in their hands, improving profitability, improving kind of ability to be climate resilient. And as always, as you expect with the DFI, being quite clear at the outset about what our intention is and how we're going to measure and report on our impact. And I think in terms of sort of building confidence in the market that you are actually doing what you'll say you're going to do, these kind of rigorous systems are really essential, because what you don't want is sort of someone a few years later kind of, poking holes in your investments and finding actually they weren't doing what you set out to do. And I think that sort of lack of confidence or sort of the risk of losing confidence behind climate investments or impact investments is sort of, something we all need to be quite kind of alert to. So I think DFIs also play a kind of a role in making sure, I mean, along with others who also have sort of signed up to whatever standards, in making sure that we are quite thoughtful and rigorous in measuring our impact and reporting on it in kind of consistent ways. And I think that will also help build the market when you can make comparisons sort of like for like, and really kind of think what your dollar is getting.
Yeah, absolutely. I think we have now heard from various panelists about mitigating risks, and when we go back to the topic even for this panel, which is about scaling, then we also have to look to the investors and how we can actually mobilize their capital. And again, for institutional investors, it's probably quite of a challenge to take some capital and allocate to Africa or other places that we speak of. So I would like to pose this question to everyone here in the panel, or take it who wants. But how do you think can these risks be mitigated the best? Is it like we heard about capital diversification, etc.? What is your approach, maybe, or a good experience, or something you can give investors to think about?
I'm happy to speak first. So our investor base are mostly institutional investors, pension funds, foundations, endowments, with pension funds being the biggest category. They're all in Europe and the US. And also we have quite a high proportion of family offices and DFIs. But the DFIs are in the minority, which is unusual for Africa. It's relatively below a quarter of our capital. Our approach in terms of attracting money, the number of factors. The first is to have a viable thesis, investment thesis, which makes sense against your impact thesis, and then to deliver on that. And so the investors will interrogate and will want to understand what type of return they're going to get. In our case, we're in the real assets bucket, so we're delivering physical assets. It's not a virtual business, and it produces a yield, and that yield that dollar yield is linked to food inflation. So in the long run, that's interesting for a pension fund. And then track record, you've got, they're looking for track record. We've been impact investors over 10 years. Our latest fund is achieving more than 15% per annum gross IRR so far. And we can show and demonstrate our impact. We've been measuring it every year. We make available all of our we can quantify impact and show it. And then you then also need to ensure your documents are institutional. You need a standard of product as possible. It's probably a private equity product. It's what we would have in a good jurisdiction, very clean terms and everything that a DFI or an institution investor would understand and not have to spend hours changing with lawyers. And then a strong team. Institutional investors will look for people as well. With experience, they will check on the people. How good is this? How good are their reputations, and so on. And then finally, one thing that we've found that was very, very important for institutional investors was political risk insurance. Investors coming to Africa, it's the first thing they ask about political risk. You can mitigate it by your choice of countries. You can mitigate it because you have a genuine positive impact, so communities will always support you. But political risk insurance we found is very helpful. So we insure through MIGA, the World Bank, and the US government through DFC. That provides 90% of your capital back if, let's say, an asset is expropriated. If you can't get your money out the country, you'll convert into dollars, that kind of risk, or a war and riot type risk. And we find that helps the committees, the investment committees of these pension funds who are not used to Africa and Africa risk. So those would be my main inputs on that.
I think if I understand, if I remember correctly, almost all of you use technical assistance, especially those of you who invest directly. How important is this?
Maybe I'll come in, but I'm going to make a set of broader points, not just address your technical assistance point. But let me start there. We actually don't do technical assistance. And I like to call that out very often, only because I think you've, in some respects, almost started with accepting that there is an entrepreneurial gap or an entrepreneurial team gap which exists, and you've not got the right person with the right domain expertise. And I think there's an inherent challenge out there. So if you get the entrepreneur right, then the entrepreneur has her networks or his networks to be able to scale a business and think about it, rather than having to address the challenge of saying, okay, I have somebody who I need to help from that standpoint. So it's one of the reasons, we often say we're not a deal shop. We do 2 to 3 investments a year. We're very thoughtful. Though we're investing relatively at an early stage, we don't take venture style risk because we want 8 out of 10 of our companies to succeed and not 1 out of 2 to succeed, because we really want to ensure that we're getting the entrepreneur right to be able to focus on a model that meets the needs of the end customers, is built on alignment with the end customer, and ultimately builds a path to profitability and impact where there's not necessarily a trade-off, but where one can achieve the other in many respects. So I think that's one very important point. But I think maybe I'll come in on a different dimension of the scale question, which is how do you build scale at a portfolio company level? Because you need to be able to absorb the capital. One is to raise the capital, the other is to actually put the capital to work. And I think that's an equally important challenge. We think of scale in 3 phases. The first phase, and I think this applies for any business model, whether you're focused on impact or not, or sustainability or not, or both. The first stage is what we call distribution economics. It's about getting the economics of your business right. What's amazing, since the topic out here is emerging markets, if you're focused on the retail side of impact, or you're focused on the retail side of sustainability and climate change, which is not the big top-down infrastructural solution, but actually dealing with the low-income customer and ultimately a solution out there which addresses the affordability and the sustainability dimension. What's amazing, it takes only $2 to $4 million to establish a business model. This is not a space where you need $50 million to prove a business model at the retail end of the equation. And then, given the size of the problem in terms of low-income communities and who we need to address, capital is the key constraint to growth and scale. And so that brings me to the second stage of building a business, which is to build the organization to be able to scale that proven business model and to be able to absorb that capital. Both these first two phases, in our experience, take about 12 months to 18 months in an ideal world. And then if you get those two right, then you have a proven business model, you've got the organizational capability, and you can go to the races in terms of the amount of capital that you can raise and reach millions of customers. So I earlier mentioned just short of $200 million of our equity that's gone into a range of companies. That's gone to 35 million households, effectively, which is the customer base of the 40-odd companies that we've invested in. Again, I'll repeat, many of them are early, so we think that number will go up considerably. So if you take average family sizes of 4 or 5, we're talking of a fairly significant impact footprint that exists. But I'll tell you how broken these two worlds of impact and sustainability, or low income and sustainability kind of pieces, are broken. None of my companies have really been approached by a sustainability oriented investor saying, I want to invest in them, even though we have the distribution footprint on the ground. And I suspect that many companies which have established themselves on the climate change and the sustainability side of the equation, we've never seen a more traditional impact, affordability, low income kind of investor going in and saying, listen, I bring a different value set because that business model may need it. These two worlds are almost operating in very, very independent, strata, if you will. And so I think we really need to focus on business models. And I would argue, if we really want to create impact, which is long-term, which is enduring, we need to think about 3 or 4 different principles. So I'll repeat: discipline and focus in terms of stages of building companies and deploying capital, which is appropriate to those stages, which I think is one. Secondly, we need to find aligned pools of capital that are going to maintain the integrity of the business model that is customer focused at scale. So I think that's a second dimension, which is very, very important. Third is we need these business models to be profitable. They need to work, and they need to work beyond the initial stages where we may have subsidies or different kinds of blended finance models, etc. Because if we want the billions of dollars of capital which exist in the mainstream world to come into these sectors, it's going to be very important to prove these business models out beyond that kind of initial incentive. That would, I'd say, the third. The fourth dimension is ultimately we need to add value to the customer on the ground. And I think that's very, very important. We have a phrase internally that we use, part of our framework, which is the customer business value. What is the value that you ultimately deliver to the customer? I'll give you a simple example. If you think about an insurance product, the premium that is paid by the customer is the revenue of the institution that is providing the insurance product. But that has got nothing to do with the value that the customer gets. What value the customer gets is the actual insurance product and the payout under that insurance product, maybe a health insurance product or any other kind of insurance product. And I think we have to think about how to build that customer business value considerably beyond the initial entry product, to be able to think about the complexity of the challenge that they have, the vulnerability, the resilience that they have, and therefore the opportunity. And how do you really build and scale that? Because then through that, you come back to the first principle. You've delivered value to the customer. You've got a profitable business. And if you've got those two, then capital will flow automatically. It's just a question of whether the capital flows through the fund managers, which have the right track record, who have been at this for a while, know what they're doing on the ground. And I would argue a team where the fund manager is also on the ground is very important. It's not just that the entrepreneur is on the ground.
Yeah,
I'll stop there.
Thank you. I think these were very interesting points. Arturo, you mentioned the importance of catalytic capital or the role. What would you say to Sandeep's intervention? Do you agree?
Yes, I think that's many times in emerging markets and frontier markets, even if the entrepreneur is the right person, he has so many things against him, and the ecosystem in so many ways is just so difficult that some technical assistance and experience and many times that technical assistance can be flexible, really, to address how can we help? What do you need if you would get extra capital? And sometimes it's even financial reporting or sustainability reporting in things that it can help. But going back to your first question about risks, I believe we have discussed mainly financial risk. And it's very important, obviously, because if we don't value risk properly before making an investment, nothing else will work. But we need to take into account as well the impact risk. And I think that is getting harder and harder because the term is very fashionable, as we know, and I believe that faking impact or impact washing, it's getting easier. And at the end, just with a good budget, you can invest in a very good consultant to make a very good impact report, sustainability report, impact framework to sell to your investors. And I really think we monitor over 500 funds, over 500 impact funds in the world, and it's getting harder and harder for us. That's all we do, to really assess and find those managers that are really committed with impact. And this is extremely important because the risk, perhaps in the short term, is not as perceived as important as a financial risk, but there are many things that can go wrong. There is reputational risk for any investors that can happen if you don't find the right person to manage, or the right entrepreneurs. And also, I believe that perhaps today the society or investors not all of them can assess whether an impact fund is really impact or not. But over time, investors are also getting more sophisticated, and over time they will be able to differentiate. So if you sell them something, and after 12 months, after 12 years, they will eventually tell them, listen, I didn't know that at the time, but now I know that you sold me something that wasn't really there. And also, again, the reputational risk is important, and we're working generally with very vulnerable and fragile ecosystems. And if impact is not at the core of what we do, we can definitely do more harm than good. We're talking about scaling investments in emerging markets, but not an investment in emerging market per se is not good. And we know how our industry, the financial markets, can come in and out depending on and really do more harm than good. So I think the impact risk is something very, very important to assess as well.
Yeah, thank you. Great mentioning this. We're actually coming to an end already. And I'd like to ask one more question to each of you. If you think of a pension fund manager or whatever institutional investor that is about to take a decision to invest in emerging markets in a climate-related topic, what practical recommendation will you give him? Everyone, very brief, please.
I will start. I would say, and yes, we want to scale, but we want to do it sustainably. And not sustainably from an environmental point of view, but from a resilient point of view. So I would say or recommend, do it gradually, do it well-informed and with good advice. What we don't want is pension funds start doing their first impact investing, 2020 happening in a black swan scenario, that investment going bankrupt and losing 100% and never wanting to go back into impact again. So I also think that, institutional capital should be relatively risk averse. We have the DFIs to help us with the more risky investments, but we need to do it sustainably and we need to do it gradually and very informed.
I would say find the right partner for your strategy. Like all investing, having aligned and understanding, having alignment is crucial, and having that trust is also crucial. So, obviously, I guess if people have been listening today, there will be various options open, but I think that's what it comes back to: your strategy and your choice of partner. There are certainly people like us, like others, who come in either sort of early or sort of once the investment is, to support the investment, to ensure from our point of view and from everybody's point of view that it is sustainable over the long term. And I think that long-term horizon is something that that DFIs have that sets us maybe apart from other investors in the market. And if that's your long-term horizon, that would be a good partnership.
Okay, thanks. Yeah. I think with impact, there's going to be an element of development or growth capital about what you're doing. You're not just buying and holding something, so you do need to have a long time horizon. I agree very much with Liz, have the right partner with you, but use the same disciplines you focus on any fund. So look at the investment process. Who are the people running it? How's risk managed? What is the track record? It's the same process, just happens to be an impact fund, and you're going to add in track record on impact as well as on performance. Thanks.
I'll just come in quickly. I completely agree with Gary. I think track record, the integrity of that track record, the integrity of the manager to that track record, I think those are the factors that I would look at. And that obviously speaks to both the commercial dimension as well as the impact dimension. Ultimately, there needs to be a thesis. That thesis needs to be aligned, and that's the basis on which you would allocate capital.
Perfect. I think this is a very good last word. So with this, actually, I would like to thank all of you, Liz, Arturo, Gary, and Sandeep, for this great panel. And I'd also like to thank Phenix for organizing this conference.
Thank you.
Thank you very much.
Miriam. Thank you, Phenix. Thank you, everyone.
Thank you very much indeed. Thanks to all of you for having been here. And thank you, Miriam, for asking for these great summaries, which I think we couldn't have done any better. So I will leave it there. Thank you so much. This was very insightful, and we will hurry on to the final closing keynote. Thank you.